Hi, everyone. As you are filtering in here, I'll go ahead and give a quick introduction for us, and then we will jump in and go ahead and get started. And before we do that, too, we're going to go over just a few housekeeping items. So thanks for coming out today and joining us for part 6 of this series. If you are here for CPE credit, we do need you to do a few things in order to receive that CPE credit. Today we have 5 poll questions. You do have to answer all 5 of those poll questions in order to receive CPE. If you are having any issues with that, please send me a message. I'll help you get that sorted out. Just let me know as soon as you possibly can when that's not popping up. You will also need to fill out the survey at the end of this webinar. It will again pop up for you automatically as you're exiting. It will also be sent to you in 24 hours. You have to do both of these things again in order to receive CPE. A couple other things that are important to take note of here. If you have questions as we are going along, please reach out and ask those questions. You can use the Q&A button in the middle of your screen. If you just wiggle your mouse around, you'll see it pop up. You can send those questions at any time. We're going to do our best to address them at the end of this webinar or follow up with you via email. So again, use that Q&A button to send those questions in. We also will be sending out the slides once we get started here a little bit. I'll send a link to the slides and the handouts. They're also uploaded to Zoom, and we'll email them to you as well. So you'll have a few ways to get your hands on the slides and handouts. And a quick little plug for ourselves. We have a pre-recorded webinars available in our Salt Vault. You can also get those as standalone, but if you have questions, please ask. CPE is available for those standalone webinars as well. And let's do a quick intro for Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, and like our name states, more. So if you have questions about our services, please reach out and ask. We would love to work with you and we'd love to hear from you. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded, and he has helped thousands of companies of all sizes and in all industries, and is especially well-known for his work in the e-commerce industry. And Mike, if you want to take it from here, let's go ahead and get started.
Okay, well, thank you for that wonderful introduction, Ellie, and thank you everyone for joining us today. We've got a lot of information to cover in the next 90 minutes, and we're going to start with some certificate basics. We're going to talk a little bit about good faith acceptance. We're going to go over certificate valuation, international transactions. I've been seeing our clients experience a number of problems with international transactions, so we're going to spend a little bit of time on that. We're going to talk about certificate best practices. We're going to talk about the importance of certificates. We're going to talk about some common mistakes when accepting certificates, and then we're going to talk about drop shipping. And we talk about drop shipping in this webinar because I see more problems with certificates related to drop shipping than any other topic. So we're going to talk about some alternative documentation, and then we're going to go over some sample certificates. But before we get started, Ellie, why don't we jump in with this first poll question?
Yeah, that poll question should be up on the screen right now. We just want to know if you were at last week's webinar. And Mike, your internet is lagging just a little bit with that video, so why don't you go ahead and turn that video off? And we'll miss seeing your face, but luckily I think that there's a picture that'll pop up for everyone. So quick reminder, you do have to answer these poll questions in order to receive CPE. It looks like answers are still rolling in here, Mike. Let's give everyone just a couple more seconds and then we can move forward.
Okay. I think you just didn't want to see my smiling face this morning. Okay, so let's move on. Today we're going to be talking about exemption certificates. So once you're registered, you don't have a choice. You must either collect the sales tax or collect a properly completed certificate in lieu of collecting the tax whichever is acceptable to the delivery state. So if there's a taxable transaction, you must do one or the other. Now, here's some common exemptions. There's a ton of exemptions out there, but see, these are some of the ones that are most common and you'll see most often. You have resale exemptions, manufacturing exemptions, nonprofit or religious exemptions. You have governmental exemptions and then agricultural exemptions. Now, there are a lot more, but these are the big five. Now, sometimes states have general exemption certificates or resale certificates. Other states have very specialized certificates, and some of them follow the common exemptions from the previous slide, but some states, like New York, have very specialized certificates. For example, purchases of promotional materials or capital improvement projects or college textbooks and even racehorses have their own certificates. And it's not like that just in New York. There are some other states out there that have very specific certificates. So and we're going to go through some certificate examples later on, and you'll see what I'm talking about on the actual certificate. But on each certificate, there's a place to check whether this is going to be a blanket certificate or a single item, a single transaction. You generally want to check blanket certificates, and blanket certificates allow purchases to use one certificate to cover all similar purchases from the same seller. And most states are going to allow this. Now, without checking that box, every time you have another transaction with that seller or with that purchaser, you've got to provide a brand new certificate. And if you're making lots of purchases, it's going to get old pretty quick, both for the purchaser and for the seller. So very important that you do check the blanket certificate. Now, when collecting certificates, or even when making purchases, you must make sure that the new purchases are of the same type that have previously been purchased and disclosed on the certificate. Certificates, they have to have enough information. They can't be too overly broad, but at the same time, they can't be too specific. Otherwise, you got to worry about collecting new certificates with additional information on them. So make sure the certificate is updated. In other words, for the type of purchase that you're making. Now, one of the concepts when it comes to certificates is good faith acceptance. So in general, good faith acceptance simply means that if a certificate is on the correct form, it's completely filled out, signed, dated, all of that good stuff. It makes common sense, and we're going to, spend some time on that. There's an actual exemption that the certificate is being used for. Then the seller does not have to put on her detective's hat to make sure the purchaser is eligible for the exemption. When you accept something in good faith, the state will generally pursue this should be, I'm sorry, Ellie, we need to correct this slide. It should generally pursue the purchaser if there is an issue. Okay, so if you're accepting a certificate in good faith, they're going to pursue the purchaser if they've issued it when they weren't supposed to. If you have not accepted it in good faith, then they're going to go after you as the seller. So very, very important. Now, common sense. Let's talk about that for a little bit here. There is no God-given right to an exemption. If a seller doesn't feel comfortable with the documentation that they have received, they can reject it, and they should reject it. Now, common sense. Let's say that on a certificate, someone tells you that they're in the line of business of developing software. And let's say that you sell them one desk. Well, does that make common sense? Are they going to be reselling that one desk if they're in the business of developing software? Maybe they're going into a new line. So you at least have to ask some additional questions. But in general, if someone's buying one desk of something that they don't sell in the normal course of business, they're buying it for use in their own business. So that's a certificate that should be rejected. They need to pay tax on that transaction, or they have to make you feel comfortable that, hey, we're starting to sell desks and your desk is the first one. But in general, reject a certificate like that. So they've got to make good sense in order for you to have accepted it in good faith. So there's the improper use of a certificate. So in most states, the improper use of a certificate is a criminal offense. And when we say the improper use, if you're giving someone a certificate, you're trying to avoid paying the tax. And maybe that's okay because maybe you have a legitimate exemption and you are entitled to avoid paying the tax. But if you're issuing it and you're not entitled to the exemption, that's a problem. So the seriousness of the offense is often based on the amount of tax that's being avoided. And the offense can be a misdemeanor or a felony, and it can result in criminal penalties on top of the civil penalties and interest. And in the most egregious cases, jail time could be an issue. I've never heard of anyone going to jail for this, but that's the way the statutes read. Now, this is not just an issue for purchases. Sellers also need to worry. And where I see that this is the biggest problem is when it comes to salespeople coaching customers on how to avoid paying the tax. So some salespeople are great. They look out for the company. They know what's right. They know what's wrong. Other salespeople just care about the money that they're going to make, or maybe they're under the gun. Maybe they're going to be losing their job and they need this sale. So we have to be careful what our salespeople, and not just salespeople, any of our employees that have interaction with sometimes it's the accounting department, sometimes it's the credit department, sometimes accounts receivable department. But anyone who's coaching a customer on how to fill out a certificate, well, that's not too bad. How to avoid paying the tax when they don't actually have an exemption. That's where the problem lies. So in general, you generally want to charge tax and let your customer tell you that they're exempt and why they're exempt. Then you can help them fill out the certificate. But they've got to be telling you what exemption they qualify for. That's the way that we generally, coach our clients on how to do this. So I'll give you an example. This was all over the news. It still pops up every once in a while. Sotheby's, the big auction house out of New York. They had a gentleman who was buying millions and millions of dollars worth of art. And somebody in the sales team explained to him, well, just give us a resale certificate. We don't have to charge you the tax. Well, the state of New York found out about it and they went after the purchaser and they, tagged them with penalties and interest. And this was under the Quaitam statutes up there. They went after them for about $11 million in back tax, penalty, and interest. That's a lot of money. However, they went after Sotheby's also, and because they should have known better, and because they were actually coaching their purchaser, their customer here, they went after them for almost $30 million. I think it was like 29 million or so. But the improper use of a certificate, we've got to be accepting it in good faith. What that simply means that if we suspect or if we know a certificate should not be issued or is not valid, we shouldn't accept it. We need to reject it. And sometimes that's a tough conversation, but it's something that needs to be done. Now, New York is very aggressive when it comes to situations like this, but pretty much all states have some sort of language about the improper use of certificates. All right, so we said that we were seeing lots of problems on international transactions, and um, the states cannot generally tax interstate commerce. But what is considered interstate commerce? So once something enters the continuous stream, excuse me, not interstate, international commerce. Once something enters the continuous stream of international commerce, it's not taxable. Now, what we see a lot of times, and this is where companies are getting themselves in trouble, is they send it to the purchaser directly, who tells them, well, I'm going to export it. In most states, that's not allowed. Or an agent, someone who's consolidating all of their trade, and then they're going to ship it out. So it can't go to the purchaser or to the purchaser's agent here in the United States. That's considered a delivery here in the United States, in just about every state out there, and then it's going to be taxable in that state. Now, what we talk about the continuous stream, if something is being sent to a freight forwarder, a customs broker, directly to a carrier, et cetera, that is called a continuous stream of international commerce. It's not taking a break. It's not being received by the purchaser or one of their agents, which puts a break in that stream. Now, we have to, document this. It's got to be evidence of delivery to one of those above. And the most common, one of the most easiest things to get is a bill of lading. And, you can't just, well, my invoice says that it's going overseas. That's generally not going to be enough. The states want something more than that. So a bill of lading is the most common. Just about every state will accept that. Freight invoices, of a customs broker, things like that can work. The proof that it was actually imported into a foreign country, that will work. So there are a number of things that can work, but the most common and easiest is a bill of lading. And you have to document it. And we're going to talk about, one is an exempt sale, not exempt, when it's not properly documented. So even if this did go overseas, if you can't document it, if you can't prove that it didn't make any pit stops here in the U.S., then the state can make sure that you're taxed on it. All right, sometimes additional documentation may be required. For example, in California, they have Certificate A, and it's a certificate supporting a bill of lading. And basically what this does is it's proof that they're in the business of exporting. I mean, you can't just send it to someone and they say, well, we're a freight forwarder. I mean, a lot of times in many states, freight forwarders, customs brokers, they have to be licensed, and that's or registered. And that's what California is looking for on this certificate. If it's a big name and everybody knows who they are, you're not going to have any problems just with the bill of lading. But if it's, John Jones, um, and no one's ever heard of them before, and, we've got to make sure that they are actually in the customary business of making exports. It can't be you're the only customer that they've ever had and that they're going to do this for you. So sometimes additional documentation can be required, and that's proving that this bill of lading is actually from someone who's makes exports in the normal course of business. All right, so some certificates have expiration dates on them. In some states, certificates never expire. And then in other states, there's not an explicit expiration date, but the state says, okay, this certificate's good for 3 years. So in the states where the expiration date is actually on the certificate, that's easy to track. But what happens if it's not on the certificate? You got to know the state requirements, and you got to be updating your certificates when necessary. So in a state like Florida, the expiration dates are actually specific to the type of exemption. Resale certificates generally good for 1 year, while other types of certificates are good for 5 years or so. Um, Now, and we'll talk about this more a little bit later, but um, even when a certificate doesn't expire, a lot can happen in a 3 to 5 year period, which is generally what audit cycles are. Some states have 3 year cycles, some states have a 4 year cycle. So a certificate may be great on the day you accept it, but a lot can happen over time. This is an extreme example, but I looked at a certificate one time. They had it on file for 27 years, and there had to be 5 or 6 different um, reasons why that certificate would have been deemed invalid over the course of those 27 years. Anytime your sales tax number changes, the certificate becomes invalid. So we had a company, they changed states. They moved from Texas to Oklahoma. And they still had the Texas certificate on file. They changed names, they changed ownership, they changed entity types. I mean, it was just a whole bunch of different things that would have invalidated that certificate. So you can't just put a certificate on file and think that it's going to be good forever. As a best practice, we suggest renewing your certificates every 3 to 4 years. Now, that's only with your active customers. Why bother wasting your time and energy if someone's no longer a customer? They're not going to be making any purchases from you on a going forward basis. So your active customers, you want to make sure that you have valid certificates on file. And a lot of times, information is updated in the invoicing system, and it's updated, in the CRM system, but for some reason, it doesn't get updated wherever you're tracking certificates. So you want to make sure that everything is correct. It's the correct name. It's the correct sales tax number. It's the correct address. It's the correct state. So expiration dates are very, very important. Here's a list, and I think Ellie's got this as a handout. This talks about the expiration periods for certificates. We've talked about updating certificates, in states that expire, where it's actually written on the certificate what the expiration date is, pretty much a given. In states that don't have it written on the certificate, you got to know what the rules are, and you got to know when someone gave you that certificate and update it when it does expire. And then we talked about this. In states where certificates don't expire, we suggest as a best practice to update the certificates every 3 to 4 years, because a lot can change in that 3 to 4 year period. So it may have been a great certificate when you accepted it, but now it's not. It has become invalid for some reason. All right, so when is an exempt sale not exempt? When it's not properly documented. Very, very important. If you don't have the documentation to prove the exemption, the presumption is that all sales are taxable unless there's some sort of an exemption. And when we're talking about tangible personal property, and if you don't have the documentation to prove that exemption, then the state is going to treat it as a taxable sale. Now, has it always been this way? Not really. Certificates right now are probably the biggest cause of large assessments for companies that are responsible for collecting certificates. And one of the reasons is because they changed the way that they look at certificates. Back in the last Great Recession, 2007, 2008, 2009, 2010, that period in there, states were really hurting. They needed more revenue. I mean, income tax was down, sales tax was down. Their citizens needed a lot more resources. So the states really, really needed money, and they didn't want to raise the taxes. Their citizens were already hurting, but they needed the money. So they said, okay, let's look at the books and see, how we can raise some money. And they looked at the laws regarding certificates, and they realized they weren't enforcing them. So up until that point, it was really a matter of uh, substance over form. In other words, if the auditor or the state could tell that this was some sort of exempt transaction, they gave you a whole lot of latitude. And in fact, some companies like distributors or wholesalers, the state said, we're not even going to audit those types of companies because there's no money there for us. Why waste our time and energy? Well, all that started to change, and virtually in some states overnight, it went from substance over form to form over substance. And what that means is you've got to get every I dotted, every T crossed. It's got to be on the right form. And these companies, because they were never required to keep great records before, all of a sudden were paying large assessments to the states. And the state said, wow, this is really working. So when the economy got better, you would think that maybe the states would go back to the way it was, and not so. If anything, we have seen a tremendous explosion and growth in this type of thinking. Pretty much all states are looking at it this way. And that is why certificates are such a big problem for companies that have a requirement to collect certificates. Number one problem for large assessments. And by the way, now companies that had never been audited in the past are all of a sudden getting audited. States will audit wholesalers, manufacturers, who have never had taxable sales before, because they want to make sure that they're documenting these sales correctly. So, over the years, I've talked to companies and they said, oh, well, it's never been a problem before. Those are always famous last words. Just because it's not been a problem in the past does not mean it's not going to be a problem going forward. And as more and more companies have been found, that creates more and more problems for their customers, who now have to figure out what certificates are acceptable. So the states view this as low-hanging fruit right now. And, even one missing certificate can have a huge impact. Um, because audits are done on a sample basis, you're not talking about just the tax on the one invoice that would have been cleared by a certificate. You're looking at the error percentage, that's got to be extrapolated out over the population here. I'll give you an example. I was involved in an audit, and this was a Texas audit, and it was a company that was building highways, and they had a lot. It was $3.5 million audit. We got involved after the audit phase. It was in the redetermination phase, and 60% of this $3.5 million audit were related to certificates. Now, we helped this company out. We got all the certificates but one. We did a great job on the audit. We even found some refunds that we were allowed to put into the audit. So we got this $3.5 million audit down to $17,000, except for this one missing certificate. And what they had done is they had sold a piece of heavy earth moving equipment to an individual who said they were going to export it overseas. And this they, for whatever reason, they didn't get a certificate. Uh, This was the one thing that was outstanding in this audit. Now, sometimes you can ask the state to exclude it from the sample and detail it, pay the tax on that one transaction, but the state doesn't have to do that. And in our instance, we had already gotten so much done. The state thought they were getting 3.5 million. Now they're looking at 17,000 if they with the exception of this. So the state said no. They made us keep it in the sample. And when it was extrapolated, it was a lot of tax on the one invoice. It was $8,000. No one wants to pay $8,000. But when they extrapolated it out, it came out to over a $270,000 impact. So even one missing certificate can have a huge impact on the results of an audit. Now, the client was still ecstatic with us. We took a $3.5 million audit down to just under, $300,000. They're paying less than 10% of what the state assessed them. So they were still happy. But if they had, a good exemption certificate management program in place, whether they did it internally or whether they outsourced it, they could have saved themselves 270 some odd $1,000. Now, most of us are not going to run across $8,000 invoices, and one missing certificate may not be that big of an issue. But we do a lot of exemption certificate management. And what I find is that salespeople are going to go to their bosses and say, hey, we need to make this sale. We need to do this. Can you make an exemption? We'll recommend that a certificate be rejected. And they can override us, of course, and they do. So after about 4 or 5 overrides, I generally have to get on the phone with them and say, every time you override one of our recommendations for rejection, it's not just the tax on that one invoice that you need to worry about. But if that shows up in an audit, you got to worry about the error percentage. So you got 3 or 4 of them here. If it's a, couple of $100,000 worth of tax in a sample, what percentage of it is this going to be? So these certificates start to add up. And once people realize that certificates have an outsized impact on an audit, they usually stop. They say, okay, we're not rejecting. We're going to take all your recommendations going forward. We're not going to make any exceptions. Now, every once in a while, you need to make an exception for whatever reason. Your best customer, you're going to lose, millions and millions of dollars worth of business because of one certificate. That's a business decision you need to make. But in general, certificates are very, very important, and they can be very, very costly. All right, so it's not just making sure that you're collecting the certificates. It's not enough just to collect it. I have reviewed certificates, and I joke about this. If the word certificate is there, I've seen it. I've seen death certificates, marriage certificates, birth certificates, all types of certificates in someone's, file. So it's not just enough to collect a certificate. I mean, I've seen sales tax permits, and most states don't accept sales tax permits. They want what they want. So someone's got to be reviewing it for the most common reasons that it could be kicked during an audit. And they got to make sure that you've got good faith acceptance. It's got to be on the correct form, completely filled out, makes common sense. And we got it right here. The state will generally pursue the issuer if the purchaser was not entitled to the exemption. So very, very, very important that someone's validating. Maybe the sales force is the team that is very involved in collecting the certificates. Maybe it's the credit department. Maybe it's new account setup. Maybe it's accounts receivable. Maybe it's the accounting department. But somebody with knowledge needs to be verifying them. So that probably is, unless you're training people in other departments, someone in the accounting department, or maybe you're outsourcing it to a company like us. But these certificates have to be validated. And I'll tell you, the most common problems, the reasons why a certificate would be kicked during an audit are for these circles here. So this is a Texas certificate, and they're generally not completely filled out for one of the big reasons why it's being kicked. So, in the upper left-hand corner, that circle is the purchaser's name and address and all that information. Right below that, it's the Texas sales tax number. And Texas is fairly easy. If you're not required to be registered in Texas, you can just put your out-of-state registration in the on the line below it. Now, you don't have to check to see if they give you a Texas number, if that's a valid number, but you do have to count the digits because there are 11 digits in a Texas sales tax permit number. If you've got 10 digits, there's a problem. You got 12 digits, there's a problem. And you need to either question what's going on or reject the certificate, because the auditor is going to reject the certificate if they see there's an issue there. So you don't have to make sure it's a valid permit number, but you do have to make sure it has the correct number of digits. And there are some other states like that, like Illinois. Now, the next section is either purchaser named above is buying for resale, and then you put the seller's information in there. A lot of times this is just left blank. They figure, oh, the seller knows who they are. They can fill it in themselves, and the seller doesn't fill it in themselves. And then the auditor asks for the certificates and the seller's information is missing. Boom, next thing you know, it's set up in the audit. So it's got to be completely filled out. So the next box is the description of items to be purchased. So this can't be too vague, but you don't want it to be too specific either. You want really the Goldilocks bed. Enough information there that an auditor looks at it and says, okay, yeah, this will cover this. But not so specific that it's going to exclude certain items on future purchases. Now, upper right-hand side, this is where common sense comes in. So this is the description or type of business. So you got to tell them what you're doing, So in my example, if I say that I'm developing software and I'm buying a desk, okay, I'm looking down in the bottom left-hand corner and looking at the upper right-hand corner. That's the common sense piece. Does it make sense? And then if it doesn't make sense, you've got to reject it and charge the tax. You may have an upset customer, but it's a heck of a lot better having dealing with it up front than having to pay the state a whole boatload of penalty and interest on top of the back tax out of your own pocket. And outsized, it's not just the tax on that one invoice. I mean, they have an outsized impact in an audit. Then you got to make sure that it's signed, the title is in there, and the date's on there. So many certificates we review are just not signed. So we're constantly sending them back and saying, please sign this when we're managing someone's certificates. So most of the mistakes when it comes to exemption certificate management, validation of certificates are real simple and real easy to prevent. Some of the tougher ones are making sure it's on the right form, making sure that there's an actual exemption. I mean, resale, yeah, there's a resale exemption out there. But maybe in one state, there's an exemption for solar panels. And you've got a special certificate for that, and you're trying to use it in another state where that exemption doesn't exist. So that's a little bit tougher. Alternative documentation, if someone, and we're going to go into that a little bit deeper. I'll stop talking about that now. But most of the time, making sure it's on the right form, that there is an actual exemption in the state where the shipment is being made, and that this is completely filled out and makes common sense. That's what the validation process is. You're going to make sure that it survives an audit. And if you accept something in good faith and it's completely filled out, um, the auditor can't question it, or they don't question it. It's when the it's kicked during an audit for whatever reason. Now the auditor, you have a chance to go back and perfect that certificate in most instances. But now when it's delivered, the auditor does put on their detective's hat. So you want to make sure that these certificates are perfect when you give them to an auditor, because a lot of times when the auditor puts on that detective's hat, they go back and they say, well, this person was not registered at the time of this sale. So this certificate is obviously no good. So auditors generally are not going to question something if it's completely filled out, makes common sense, is on the right form. Um, and that's why it's important to be doing this prior to being audited. However, if you are audited and you haven't been doing this, you usually have some time. You try to get as many certificates as possible. It's called XYZ work, because that's what California called it. So most states, most companies like ourselves call it XYZ work, where we're sending out letters and calling your customers and trying to get all these missing certificates, or trying to get your customers to tell us that they remitted it as a use tax. So a tax only needs to be remitted once. The state's not going to go out there and search for it. They're not even going to tell you. They'll say, "Oh, sorry, we can't talk about someone else's, business." Um, so if the customer tells us, "Oh yeah, we paid this as a use tax," they need to tell us what um, period it was paid during. And generally, that's going to satisfy an auditor. Maybe it was paid through an audit. Well, what was the audit period that it was paid through? Maybe it was taxable. And some of our customers say, hey, if they say it was taxable, then we want to invoice them. That again, that's a customer service issue, but you can go back and ask for the tax if it was a taxable sale and the tax was missed. So quite a number of things to do before the auditor asks to see those audits. And a lot of times, as soon as you give them a list of all your exempt sales, depending on how many there are, they may turn around and say, okay, I want to see all of them. Or they may say, here's the ones I want to see. So as soon as you know that you're getting audited, since you know this is such a big problem area, if you have not been doing a good job with your certificates, now it's time to run the fire drill. Now it's time. You got to get as many of these certificates as you possibly can, uh, so that you get them all to the auditor at the same time. All right, so here's some best practices. Number one, you got to have a system, and you got to decide who's going to manage the system. You know, um, who's in charge of collection? Is it going to be the sales department who's out there asking for the certificates? Is it going to be new account setup, your credit department? Is it going to be accounts receivable? Is it going to be the accounting department? I mean, there are a number of people who can do this, but you got to decide who's in charge, who's going to be responsible for collecting the certificate. Um, Validate. This can't be an automated process. I don't know a way for any type of software to be able to tell if something makes common sense or not. So there's got to be a validation process, and you can do that in-house. You can uh, outsource it to someone like us. And by the way, I haven't mentioned software. Software, some of these companies out there will tell you, oh, well, just sign up for our service and you don't ever have to worry about anything again. Famous last words. I don't know of any software out there that can do this totally. I mean, it's a blended process. You got to have some sort of human interaction. Now, you can hire someone to do that human interaction. I mean, Uh, we have software that we use to make our job easier. We also do the validation, manually. A company like Avalara, same thing. They have the software that can make your job easier, but someone's got to be doing the actual validation. I mean, software can track expiration dates. You can send out a pre-filled certificate from software. I mean, those are all great things, but you're not going to be covered 100%. It's the validation that is the biggest issue. Is this an actual certificate that's going to survive an audit? And software can't do that. So you're going to have someone internally or outsource that, which is an extra charge with a company like uh, Avalara. With us, it's one charge for the entire service. Um, Now, you got to be able to store your certificates centrally and digitally. In other words, they've got to be accessible to anybody who needs them. We were involved with a company a number of years back, and they were still keeping their certificates in file cabinets. And in this day and age, to me, that's just totally ludicrous. And they had 8 different regional offices throughout the country. And one office didn't know what the other was doing. They didn't know if a certificate was on file or not on file. They were not coordinating with the accounting department. Invoices were getting short paid because companies were coming back and saying, providing certificates later on. Well, if the accounting department doesn't know that a certificate was received after the fact and they remitted the tax on an accrual basis, this one company came to us, big, if I mentioned their name, everyone would know them. And the parent company got onto them and said, "Hey, why do we have so much money outstanding?" And they figured it out. It was all these short pays, and it was all falling out of statute. That's how long it had been going on. Statute of limitations for refunds is either 3 or 4 years, depending on the states, and they had $1 million a month in refunds that were falling out of statute because they didn't have a system that everybody could access. It wasn't central. It wasn't digital. So, we helped them out as best we could. But and we got a lot of those refunds. They didn't have the time to buckle down with that many expiring every month, but they still to this day, I think, are having issues with not storing their certificates centrally and digitally. So very, very important. And, as we mentioned earlier, you want to be updating your certificates every 3 to 4 years because a lot can happen in a 3 to 4 year period. I mean, an auditor could look at it during this audit cycle, and then you get audited again, 3 years from now, and it was good for this audit cycle. It's not good for that audit cycle because the information, when an auditor looks at an invoice, they have all the information, and if the certificate doesn't match the information on the invoice, a big one, by the way, is the name of the company. People say, "Oh, well, it doesn't really matter." It doesn't matter. It's going to throw up a red flag. So you want to make sure that the names in your invoicing system are matching the names on your certificates. Ellie, why don't we go to the next polling question?
Absolutely. We have a true or false question here. True or false, if a certificate is on the correct form, completely filled out, and makes common sense, the state will generally pursue the issuer if the purchaser was not entitled to the exemption. So let's give everyone a little bit of time to answer. Quick reminder, you do have to answer these poll questions in order to receive CPE credit. We have 3 more coming after this one. There's 5 in total today. You have to answer all 5. My answers are still rolling in pretty quick here, so let's give everyone a quick second while you review this, if that's okay.
Yeah. And I'm going to help some people out here. The correct answer is true. So issuer would be the purchaser. So if you accept something in good faith, which is what that's talking about, correct form, completely filled out, makes common sense, the state's generally going to pursue the purchaser if that exemption was not valid. Um, so if you accept something in good faith, it absolves the seller. So that would be true. All right, so let's start talking about drop shipping. And every webinar I talk about drop shipping, someone will always ask me, well, Mike, what is drop shipping? I'm not familiar with the concept. Well, it's really just a fulfillment method where the seller doesn't have the inventory on hand when they make the sale. Now, instead, when a seller makes the sale, it purchases the item from a third party and has it shipped directly to the customer. Now, this could be for a number of reasons. Maybe they ran out of inventory, and rather than have their supplier send it to them and then they turn around and send it to their customer, which adds to the shipping costs, and it adds to the time, they're going to ask their supplier to ship it directly to their customer. So that's one reason we see drop shipping. Another is it's a business model. And, especially with the advent of e-commerce, it's a cheap way to get into business. I mean, you don't have the carrying costs of all of that inventory. You're just purchasing items after the sale is made. So, real simple definition, drop shipping fulfillment method where a seller doesn't have the inventory on hand or own the inventory. So why is drop shipping so confusing for so many out there? For some people, it's not. They got it down. But for most, and some of these people are very smart people and they know a lot about sales tax, but drop shipping becomes very confusing for them. And one of the reasons is it's at least 2 transactions. Sometimes I've been involved where there's been 5 or 6 transactions involved. Someone buying from someone who's buying from someone who's buying from someone. So it's at least 2 transactions, though. A lot of terminology is different. I mean, one state is talking about manufacturers. Well, what happens if you're not a manufacturer? Do the rules apply to you? I mean, so the terminology is different from state to state. A lot of misinformation out there, people just don't understand, or they're getting their information from their competitors. Disbelief. I mean, a lot of people think sale for resale is a sale for resale. So why are you asking me for tax, or why do I have to provide anything? Or why won't my Texas certificate work in the state of California? So there's a lot of disbelief in there. And sometimes it just comes down to we don't know, or we don't apply the basics. We may know the basics, but we hear the word drop shipping and we forget to apply the basics. And if we do these things, we can keep it pretty simple. So what we want to do is look at each transaction separately. We want to standardize our vocabulary, and we want to remember to apply the basics. And if we do these things, we can demystify drop shipping. And we can make sure that it doesn't cause us problems in audit, or we'll go over some of the problems that it causes for sellers as well as purchasers. All right, so here's a typical scenario using standard terms. All right, so retailer offers products, not an inventory. The consumer places an order with the retailer, and then the retailer is going to turn around and place an order with the supplier, and they ask the supplier to ship to the consumer. So we're not going to use manufacturers, vendors, any of those words. We're going to use today in our presentation these terms: retailer, consumer, supplier. I think that helps us understand it when we're using standard terms. Now, Wayfair, I think it had an outsized impact on companies that either are the suppliers or the retailers. And for the retailers, they now have potential nexus in more states. Marketplaces, maybe I'm selling on a marketplace and I used to be able to collect the tax, and I would just, give myself a credit for the tax that I paid at the time of purchase. But I'm not collecting the tax anymore. The marketplace is. So how does that work? Certain states, like California, have done a great job of doing, laying out what the rules are for that. Um, More registrations, more returns, more certificate requests from suppliers, because guess what? My suppliers have nexus in more states, and now they need to be worried about more certificates. More knowledge needs to be learned. What is alternative documentation? And alternative documentation is, if I'm not registered in a state, is there anything else that I can give to my supplier if I don't have Nexus? And this is only available if you don't have Nexus in the ship to state. So, got to know what these things are. And we'll go into this more detail later. But otherwise, you end up getting registered in too many states. Otherwise, you end up paying too much tax to your suppliers. So you got to, have the knowledge of what your options are out there. All right. So the impact of Wayfair on suppliers, pretty much the same issues that, impact retailers. You got potential nexus in more states. More states count resale transaction, or most states count resale transactions in their economic nexus thresholds. Try to say that 10 times quick. More registrations, more sales tax returns, more certificates to collect, more knowledge to learn. What can you accept? What can keep your customer happy and still protect you? And then good faith acceptance issues. So what happens if one supplier, okay, what happens if you yourself made more than 200 shipments into a state for a retailer? Well, you yourself created Nexus for them if it was a state with 200 transactions. So can you accept alternative documentation if they actually have Nexus in that state? The answer would be no. Now, if you did 100 transactions, do you have to put on your detective's hat again? The answer is no. I don't have to ask them, well, how many transactions did you do with ABC company and DEF company? I just have to worry about myself. But it's one more thing I need to do as a supplier in order to accept something in good faith. I can't be the one that made them cross that $100,000 threshold, or the $500,000 threshold, or the 200 transaction threshold, because I should have known that this alternative documentation, which can only be used if there's no requirement to be registered in the state. If you have Nexus, there's generally a requirement to be registered. The alternative documentation is not valid. All right, so why are drop shippers impacted so hard by Wayfair? Unlike many sellers, some drop shippers, say you're in a state like Oregon, they don't have a sales tax. So maybe you didn't have a responsibility to collect sales tax anywhere. Or, maybe you had just Nexus in one state, maybe the state of Texas. Now you could have Nexus everywhere, and you got to worry about collecting the tax in all of these places. You got to worry about not paying tax to your suppliers, what type of documentation you got to get them. And then for suppliers, your exposure, you might be too lax on collecting. You're not collecting certificates in enough places, or the right places, the right states. You're sourcing your sales incorrectly, maybe. And then there's a customer service issue, but it's not just a customer service issue. It could be a sales issue. And a lack of knowledge, you can be too tough on collecting. We hear all the time, My seller's making me go out and get registered everywhere. Well, if you don't have Nexus, why do you need to register? Well, there are 10 states where you might have to do it. But in general, if you don't have Nexus, there's that alternative documentation. So the lack of knowledge. If you're too tough on collecting, it creates friction. So either customer service or sales. I mean, eventually, if there's enough friction with customer service, the sales go away. I'm going to work with someone who is a lot easier to work with. Sometimes this is due to an inadequate communication or education, letting your customers know why you need what you need. And it's got to be correct. I mean, you can't tell them, well, I need it because I say I need it. Because they're going to be hearing things from, your competitors. So it's got to be based in fact. Why do you need this? Why is my Texas certificate not able to be used in a state like California? So that could either be an education part on the suppliers, or it could be you may know everything, but you're not communicating it adequately to your customers. So, which all can lead to a loss of business. Friction can lead to loss of business and puts an incredible strain on your customer service people if they're, arguing with people all the time. So for retailers, problems created by drop shipment is the overpayment of tax. Their supplier. There I go with my non-standard language. Their supplier may be saying, hey, you can't get me this exact certificate. I got to charge you tax. So they may be paying too much tax. Needless registrations. Your supplier says you got to be registered everywhere. Well, maybe you do, maybe you don't. If you don't have Nexus, you don't need to be registered in general. So, once you get registered, now you've got a responsibility to collect tax, do returns. I mean, you're just increasing expenses. And here's a big one: ruined relationships. If I'm digging my heels in and I'm saying, hey, a sale for resale is a sale for resale. What do you mean you're telling me you can't accept my resale certificate? Well, it's got to be documented properly, and each state has their own rules on what they will or will not accept. And when we get to the basics, this ruined relationship piece may come into play a little bit more. Why people are digging in their heels, and why, if it's explained to them correctly, it may not be as big as a sticking block. Ellie, why don't we do the next poll question?
Absolutely. That should be up for everyone right now. The question is, why are drop shippers impacted so hard by Wayfair? Your choices are, unlike many sellers, some drop shippers. I can't see quite all of this answer. Let me expand this. Only have Nexus in 1 or even 0 states. They could now have Nexus everywhere, having to worry about collecting tax, having to worry about not paying tax to suppliers, or all of the above. And Mike, answers are still rolling in pretty quick here. If we want to give everyone a few more seconds, quick reminder, you do have to answer these poll questions in order to receive CPE credit. And let's just review this one very quickly and we can move forward, Mike.
And the correct answer is all of the above, which most of you have answered. All right, so let's get back to the basics. Excuse me. I had a tickle in the back of my throat all of a sudden. All right, so the basics starts with Nexus. And Nexus, just a fancy word, means link or connection. And when we're talking about taxes, it's the link or connections where the state can require a seller to collect or pay its tax. Now, we say it all starts with Nexus, because if you don't have this link or connection, the state can't require you to do anything. So no problems and no responsibility. But this, when we say this, we're talking about the seller. This is a responsibility to collect tax. It's not for the purchaser. It's not for people We say, well, I don't have nexus, so I don't have to pay the tax. Nexus is based upon the seller. So if the seller's telling you they need to collect the tax, you got to pay the tax, or let the seller know why you don't have a responsibility to pay that tax. So let's move on to rates. And, we're going to talk about tangible personal property. That's usually what's drop shipped. Not always, but tangible personal property is something that's perceptible to the senses. You can see it, you can touch it, you can smell it, feel it. So states generally base their sourcing rules for tangible personal property where the purchaser or their representative take possession. Incoterms and the like are usually not considered. Common carriers generally not considered representatives. So it doesn't matter who's paying for the common carrier. If it's going by common carrier, you're still looking at where the purchaser or their representative takes position. In most instances, that's going to be the ship to or delivery address where the tangible personal property should be sourced. There may be deviations from that, but in general, that's where it's going to be. All right, so when should tax be collected? Sellers generally required to collect the delivery state tax or a certificate in lieu of the tax that is acceptable to the delivery state if what they sell is taxable in the delivery state and they have nexus in the delivery state. All right, so it's generally never based on where the purchaser has nexus. Forget about drop shipping, just in general. Do we ever ask our customers, hey, where do you have nexus? Because if you have nexus, I have to charge you tax. And if you don't have nexus, I don't need to charge you tax. No, it's based on where we have nexus and where we have a responsibility to collect the tax. So generally never based on where the purchaser has nexus. And this leads to a lot of misunderstandings when we start talking about drop shipping. And Ellie, let's do our fourth poll question. And we're going to walk through working out.
Absolutely. So true or false questions again here. States generally base their sourcing rules for TPP on where the purchaser or their representative take possession. True or false? Quick reminder, you have to answer these poll questions in order to receive CPE. There is one more after this question, and answers are still rolling in pretty quick here. So why don't we review this one and we can move on.
That is a true answer, and most of you have gotten that right. So good job, everyone.
A little bit of a
All
quiz
right,
for you
so
on
we're
that.
going to
You had
work
to
out.
read the. Oh, sorry, Mike. Go ahead. I was
Yeah,
going to say you had to read this one, huh?
yeah. Sometimes we get tripped up. They're trick questions, but this one was pretty straightforward. All right, so let's work out an example here. And many of us, not everybody, but many of us look at drop shipping transaction as one big transaction. Consumer places an order with the retailer, retailer order places an order with supplier, supplier places an order with the consumer. And if we're looking at this at one transaction, our brain starts to freeze up very often. When in reality, it's two separate transactions, or we're going to limit our conversation today to two transactions. Could be more than that, but it's at least two transactions. So in this scenario, you've got the first transaction, the consumer places an order with a retailer. And you have the second transaction where the retailer turns around, places an order with their supplier, and this asks the supplier to ship it to the consumer. So two separate transactions. Now, the first transaction, I'd say it's easy, but sometimes it's not so easy. Retailers generally know where they have nexus. If they don't, then that's something that they need to figure out. And if you have nexus and what you sell are taxable, you've got a requirement to be registered in that state. And if you know that, you know you need to charge your customer, who's the consumer, the tax. Um, and you're obligated to collect it, if what you're selling is taxable and the consumer is not exempt. So the second transaction is where we start having trouble. The first one, usually pretty easy. Not everyone gets it. We get a lot of calls from people who we've got to walk through, what their Nexus footprint is. And if you don't know, that's okay. This is, brand new to a lot of people. But the second transaction is where we see the most problems. And it's really in the third scenario. So scenario one, the supplier does not have Nexus and is not registered in the delivery state. And when we were talking about rates, that's where sales are sourced. So it's the delivery state. For interstate shipments of tangible personal property, it's generally almost always going to be the delivery state. So that's why we keep talking about delivery state. So if the supplier does not have Nexus, they don't have this link with the delivery state, and they're not registered, they're not required to be registered, then state can't require them to collect the tax. So if the supplier doesn't have Nexus, not registered, supplier doesn't ask for anything. They don't ask for the tax. They don't ask for a certificate. So scenario one, pretty easy for everyone involved. Scenario two, the supplier has Nexus and the retailer is registered. So if the retailer is registered, then when the supplier says, hey, I got to charge you tax unless you give me a valid certificate, retailer says, oh, no problem. Here's my certificate. So again, this is a pretty easy scenario. It's this third scenario that generally gives everyone the most problems. And this is where the supplier has Nexus and is registered, and the retailer is not registered. All right. So if the supplier has Nexus or is registered in the delivery state, then the supplier must ask the retailer for a certificate. If the retailer is not registered in the consumer state, then the supplier may have to charge the retailer a sales or a use tax. Okay, they must. Remember, going back to the basics, I must either charge the tax on a taxable sale or collect a certificate in lieu of the tax if I'm got Nexus and registered in a state. So let's look at example 3 with some real life examples here. So let's say that a supplier has Nexus in California. Okay, and that's where the consumer is located, in California. Retailer does not have Nexus in California. The retailer is located in Texas, and the supplier is located in Oklahoma. So how does the tax work? Well, we got to remember the basics. Delivery state determines which state's rate or certificate to collect. The nexus of the supplier is key. Seller never asks customers if they have nexus in a state when deciding if they need to collect tax. So it's always the delivery state. A supplier must collect the tax or certificate in lieu of the tax acceptable to the delivery state, and the sale for resale may not be exempt if not properly documented. So we've got to remember these basics. So second transaction, as we said, the supplier has nexus in California. They must collect the California tax or certificate in lieu of the tax. Retailer does not have nexus in California. They're not registered. And California is what we call one of the 10 tough states. In order to issue a valid certificate in California, you generally have to be registered in California to issue that certificate. So if I don't have nexus, I'm not registered, I have no valid certificate to provide. So in that instance, the supplier must collect the tax. And again, California, we use this as an example because they're a little bit tough when it comes to this because the tax is not based on the sales price to uh, the retailer. It's based on the sales price to the consumer if known, and generally it's not known, or the wholesale price, which is the price to the retailer plus 10%. A lot of people miss this. And that 10% starts adding up. If you're doing a lot of drop shipping into California, and you're just basing it on your price to the retailer, California's going to say, hey, what about the extra 10%? And we'll go through an example there. Um, so the retailer has to pay the tax, no option. The other option would be not to do the transaction with the supplier. Or, if the supplier wants to do it with the retailer refusing to pay the tax, that's a customer service issue. But in general, the retailer has to pay the tax if they want to go through with the sale. Sale for resale, not recognized if it's not properly documented. And in this case, the California certificate is the one that needs to be used. And I can't say this enough, the nexus of a purchaser never plays a factor. So a lot of times you'll hear the retailer saying, well, I'm in Texas. I don't have nexus in California. I don't have to collect tax in California. And they're absolutely right. And they're not collecting the tax in California. They're paying the tax in California because that's where delivery is being made. So they're not receiving it in Texas where their certificate would work. They're receiving it, they're having it shipped to California. All right, Ellie, let's do that last poll question.
All right, and hardest question of the day. Are you joining us next week for part 7? Oh, looks like I misspelled a little word here. Hopefully you can make it, and hopefully you've been here for all these past webinars as well. My answers are still rolling in here. You do have to answer this poll question as well in order to receive your CPE credit, but this is our last question of the day. So we will close this one out and we can move forward.
All right. So I've been talking about alternative resale documentation. And if a retailer does not have nexus in a state, some states allow documentation that does not require being registered in a state. And each state is going to be different as to what they will accept as this alternative documentation. Now, it's important. A retailer can only use this if they don't have nexus in a state. So some states allow a home state certificate. Some states allow a consumer state. That's the same as a delivery state with no nexus statements. Consumer state or delivery state with a home state number. Streamlined sales tax certificates, MTC certificates, affidavits of no nexus, customer pass-through, and then sales tax permits. Most states don't allow that, but less than a handful do. All right, so these are the 10 most difficult states. And in these states, under some or all circumstances, you might need to be registered in the state in order to issue a valid certificate. Now, Tennessee was on that list. It was removed as of January 10th of 2022. Some people still believe that it's one of the 10 tough states. That's why we've left it up on the slide here, but it is no longer one of the 10 tough states. Illinois used to be an honorable mention. Now it's moved up into the 10th spot. So it's, not all of these states, are as tough as others. For example, Florida and Louisiana. If the inventory is located in the state at the start of the transaction, then you have to get a state specific, you have to be registered with the state in order to issue a certificate. But, Florida comes right out and says, hey, if the inventory is outside the state when the transaction started, we don't see that as a Florida sourced sale. So therefore, you don't have to worry about giving us a Florida specific certificate. Some companies don't know at the point of sale where, may have multiple warehouses, some in state, some out of state. So as a best practice, they just make you make you be registered in order to issue a certificate in that state. You've got California, which allows a pass-through of a customer certificate. Now, this is where I see the most fraud coming in. It's got to be a valid reason for a pass-through. For example, if I'm selling to a retailer who's not registered in California, who's selling to a retailer who is registered in California and is going to be reselling that item, then you can you can pass through the consumer's certificate. The consumer's certificate to the retailer can be passed through to the supplier. Now, where we see the most problems is someone who's going to be using something in their business and the retailer says, hey, just get me a resale certificate. Well, that's not something that should be passed through. That's the improper use of a certificate. The consumer's not actually going to be reselling that. They're going to be using it for the business. So a pass through of certificates is where we see some of the most fraud. But these are the 10 most difficult states, which in some or all instances, you're going to need to be registered in the state in order to issue a valid certificate. How do you tell what states will accept? Well, this is a proprietary chart that we put together. This is available in our Salt Vault that Ellie talked about earlier. If you're doing a lot of drop shipping, this is a chart that's invaluable. It talks about home state certificates, what states will accept them, what states won't. Delivery state or consumer state certificates with no nexus statements, delivery state certificates with home state numbers, the streamlined and the MTC affidavits, home state sales tax permits. As you can see, most states don't allow that. And then the pass-through of a customer's valid exemption. Let's look at some actual certificates. So this is a Pennsylvania certificate. And Pennsylvania is not one of the 10 tough states. You can actually go out to the internet. You can type in Pennsylvania resale and you can download this certificate. When you're filling it out, you want to check that top box up there, state and local sales and use tax. Then you're going to come down. It says check one. So remember in the very beginning, we said check blanket exemption certificate in most instances. Well, that's what it's here. Do you want this to be for one transaction or for multiple transactions? Most of the time, you're going to check blanket for multiple. Then you put the name of the seller and all their information there. Then you come down to the boxes, and you're going to, if you don't have Nexus or are registered in Pennsylvania, you're going to check box number 3. And where it says property will be resold under account ID, you can either put not applicable or you can put your home state number in there. And the reason why it says if purchaser does not have PA sales tax account, include a statement under number 8 explaining why a number is not required. So you go down to number 8 and you write in there, we do not have Nexus in Pennsylvania. So this is an example of a no Nexus statement on a certificate. Let's go on to New York. Again, can be downloaded from the internet. The name of the seller is on the left there. The name of the purchaser is going to be on the right. And then you come to that single use or blanket certificate. Again, blanket certificate. Purchases information. I'm engaged in the business of blank and principally sell blank. That's that common sense piece there. What are they buying? Does it make sense with what they're saying their business is? If you're registered in New York, you fill out part 1. If you're not registered in New York and are not required to be registered in New York, you leave part 1 blank, you go to part 2, and it says, I certify that I'm not registered nor required to be registered. So you would put your home state number in there. If your home state's Oregon, then you would put not applicable. You could put your Canadian VAT number in there. You say you're registered in Canada. That is an example of a home state number on a certificate. Now, real quick, running out of time here, but here's an example of the streamlined certificate. This is the new streamlined certificate. It's all on one page, the top and bottom. It used to be 2 pages. And if you're doing a lot of drop shipping, this is the certificate, the multi-jurisdictional I would accept. The MTC, which we're going to take a look at next, I would not accept that unless I knew all of the permissions that or rules that go along with it. All of these states, you can use your home state number in if you don't have Nexus, or if you're in Oregon, you don't have a home state number, you can use your FEIN number. So this is a real easy certificate. It's user friendly and Ellie's going to give out copies of all of these certificates. And here's the instructions for it. All right, so this is the MTC certificate. And it's not the whole MCC certificate. Ellie will hand that out. But you can see every one of these states has a footnote. And if you go to the footnotes, I don't see any footnotes that say whether or not you can use a home state number. And I know good and well that a number of these states don't allow home state numbers. All right, so collecting tax from retailers, tax is generally going to be based on either the price to the consumer if known. Some states skip that and just say the wholesale price. If the price to the consumer is not known, then again, you default to the wholesale price. California is the only one that I see that is different. In California, the price to the consumer is unknown, then wholesale plus 10%. Now, the sales price stays the same. The retailer is still paying, if they're buying something for $100, they're still paying $100. It's just what the tax is based on is going to be different. So, normally the tax would, if it's an 8% tax rate, the tax would be $8. But in this instance, it's not. It's $8.80 because $100 sales price plus 10% is $110. So that's my tax basis. Even though the purchase price is 100, my tax basis is 110, and 8% of that is $8.80. So the retailer pays the sales price and the higher tax amount, but not the higher tax basis. And Ellie, at this point, we have any questions?
We do. Let's since we have 1 minute technically left before we jump into these questions, I do want to say thank you for joining us. If you have to run out right at 12:30, we appreciate you participating and coming to us. Please reach out if you have questions that you don't have time to ask here or you'd like to work with us. So, Mike, on an exemption form, if the purchaser has left the seller's information blank, can the seller fill this out on their end, or must the purchaser fill out this information?
It depends. And there's reality and there's what states may want you to do. In today's day and age, a lot of certificates are collected electronically. Everybody that I know of just goes ahead and fills that information out. If you have a written certificate and everything's in blue ink and you go in there and write an address in black ink, that might create some sort of issue. But when everything's being done online, I don't think it's an issue. And with, the software out there that I was speaking about earlier, a lot of times something comes in, it's not correct. You pre-fill everything out, send it to the customer, and you say, just sign this, please. So you can fill it out with the seller's information. You can fill it out with as much of the purchaser's information that you know of. What you don't want to fill out is the customer's line of business. Because you want to accept this in good faith. So you want the seller telling you what line of business they're in and see if it makes common sense.
All right. And it looks like that's about it. Mike, is there anything else you want to cover before we close out here?
Uh, no, just appreciate everyone joining us today. I hope that this has been beneficial, and we hope to see you on future webinars.